Welcome to Delphos Insights. Today we're diving into a really crucial corner of the financial world that used to be considered pretty niche,
Very niche.
but now it's fundamentally rewriting the rules of global private equity. We're talking about secondary transactions. And our mission today is really laser-focused, designed for you. We're not just going to define what secondaries are. We're going to dissect how they're being strategically structured, how they're deployed as these essential levers in the complex landscape of emerging and frontier markets.
DM and FM, yeah.
Exactly. We want to cut through all that high-level complexity and find those real aha moments about where and how value is being created right now. And just to set the stage, here's the big picture hook that really proves this isn't some gradual evolution. Global secondary market volumes.
Yeah.
They're projected to cross $200 billion US dollars in 2025.
An incredible number.
It is. And that spike is driven by a 10% compound annual growth rate since 2021. That tells us this isn't just growth. It's a rapid structural shift that really demands our attention.
It absolutely does. And for investors looking at emerging and frontier economies, this whole global momentum, it signals a mandatory strategic adjustment. I mean, we know that traditional exits in these regions, things like IPOs, simple trade sales, they're slowing down.
And the regulatory hurdles are still there.
They persist. So this means secondaries have completely transformed. They've gone from just being a tool for, basic liquidity to being this critical mechanism for portfolio optimization and really sophisticated risk management. We have to understand the nuances, though, because it's the structuring discipline that makes this growth sustainable in these dynamic markets. As Bart Turtleboom puts it, in 2025, secondaries have progressed from basic liquidity solutions to pivotal mechanisms for sustaining and growing value.
Okay, so let's unpack that. Let's make sure everyone's on the same page here.
Yeah.
When we say private equity secondaries, we're talking about the sale of existing investor commitments or assets.
Right.
This isn't a primary commitment to a brand new fund.
Precisely. We're dealing with seasoned existing capital. It's like trading a used car versus, ordering a brand new one from the factory. The asset is already up and running.
Good analogy. And if we look at the transaction types that are dominating the market, based on data from the first half of 2025, we see two major players. You've got the LP-led deals.
Where limited partners are selling their fund interests.
Right, and they still make up the largest share, at about 54% of the volume. But the really fast-growing category is the GP-led transactions, driven by the general partners, and that's now at 43%.
That ratio tells you a lot about the GP's need to actively manage their assets, not just sit and wait.
And while, the bulk of the dollar activity is still in the US and Western Europe, the geographical momentum is shifting fast. Frontier markets, especially in Asia, they're surging. They account for over 80% of continuation vehicle fundraising just since 2020.
That's a staggering number. It shows you where the real structural expansion is happening.
So let's dig into those LP-led deals first, since they're still the dominant type.
Okay, so these happen when a limited partner, an LP, sells their fund interest before the fund fully matures. And it's usually for one of two reasons. Either they need cash, they need immediate liquidity, or they just need to rebalance their portfolio. Maybe get out of real estate and into tech. What's really fascinating about this part of the market right now is the pricing stability. In the first half of 2025, the average LP portfolio pricing, it's sort of stabilized at about 90% of net asset value, or NAV.
90 cents on the dollar.
Exactly. And that's a small, but I think a meaningful increase from 89% in 2024. It signals that the market is normalizing and confidence is coming back.
I imagine that small bump in NAV pricing probably indicates more competition among the buyers, too. But who's actually doing the selling? Who's driving this demand for liquidity?
That's a great question. The seller list is always interesting. Public and corporate pensions, they're traditionally the biggest source. They account for nearly 48% of the deals, just because they're the biggest players in the first place.
Makes sense.
But the real story here, the surprising jump, is from endowments and foundations. Their participation increased dramatically to 16% in H1 2025. That's up from only 7% the year before.
Wow, that's more than double in just a year. That kind of move suggests they're getting far more sophisticated about using secondaries not as like a last resort, but as a proactive tool.
A proactive portfolio management tool, precisely. They're cleaning up legacy assets, adjusting their risk profile, and they're not waiting 10 years for a fund to mature to do it.
They're creating liquidity on their own timeline.
Exactly.
Okay, so here's where it gets really interesting, and I think most relevant to frontier markets. This rapid rise of GP-led deals, specifically continuation vehicles, or CVs.
Right. So instead of an LP just selling an interest, here the general partner, the GP, restructures or extends the life of a fund. They roll the assets they want to keep into a new vehicle.
And the key here is the optionality it gives the original LPs, right?
Yeah, it is. They get a choice. They can either roll their stake over into the new CV right alongside the GP, or they can exit completely and get their cash out now. So it preserves the performance incentives for the manager, but gives the investors the liquidity they might be looking for.
And we're also seeing this rapid evolution in how GPs are structuring these CVs. I mean, historically, the single asset CVs, they say CVs, they were dominant.
Focused on one, crown jewel asset.
Exactly.
Yeah.
But the data shows a really significant shift. SACV volume dropped from 55% of GP-led deals in H1 2024 down to 38% in H1 2025.
That's a huge drop. And it really shows a changing risk appetite in the market. It's signaling that concentrating all that risk in just one name, it's less appealing right now.
And the mirror image of that, of course, is the rise of multi-asset CVs, the MACVs. These combine several assets for diversification, and they shot up to about 50% of the volume. So does this preference for diversification come from, the uncertainty of trying to exit a single asset in these volatile markets?
Absolutely. The MACV structure spreads your risk. It provides a more predictable cash flow profile, which is highly attractive to secondary buyers. Plus, it gives the GP more flexibility. Think about it. They can manage several mature assets together, optimize them for a better exit later, instead of trying to force a sale on one asset at a bad time.
And we've also seen GPs are using more external financing in these deals.
Yes, that's a key point. Third-party leverage has almost doubled from 6% to 11% this year alone.
Which, increasing leverage in these already complex structures, it definitely raises the stakes. This strategic benefit of CVs extending an asset's life, that must be absolutely vital in emerging markets.
It's the core benefit. In markets where traditional exits are just notoriously slow or sometimes blocked entirely, CVs ensure management continuity, they preserve those crucial long-term relationships, and they give assets the time they need to fully mature.
But you brought up leverage, and that brings us to management.
Yes. Because these structures are so complex, effective management really relies on absolute transparency and robust due diligence. And we're not just talking about the NAV, you need total clarity on things like carried interest, management fees within the new CV, and a reliable system for monitoring the underlying companies to ensure the valuation is fair for everyone, the rolling LPs and the new buyers.
And all of that, the due diligence, compliance, valuation, it all becomes exponentially harder when we focus specifically on frontier markets.
Yeah.
I mean, we have to acknowledge that structuring secondaries in EMFM requires a massive amount of adaptation to what the source material calls local realities.
That's the perfect phrase for it.
The biggest challenge here seems to be valuation opacity and illiquidity. Because transparency is limited and conventional exits are so hard to guarantee, assets in these markets often trade at a pretty significant discount. We're talking 10 to 30% discounts to NAV.
It's a huge hurdle.
So the question is, what are the primary structural solutions that buyers and GPs are using to overcome these constraints?
You've hit on the core problem, that gap between the perceived value and the price you can actually get. And we've identified 4 key structural considerations that you absolutely have to nail down to bridge that gap.
Okay, what's the first one?
First, you have to bridge the pricing gaps. That persistent 10 to 30% discount, you can overcome it by mandating independent third-party valuations and, critically, by structuring staged liquidity.
What does that mean, staged liquidity?
It means the buyer might pay a lower price upfront with subsequent payments contingent on the asset hitting certain performance milestones. It aligns the buyer and seller over time, and it addresses that uncertainty head-on. It's like a structured earnout.
That makes a lot of sense. So what about currency risk? That's always a huge headache in EM.
Second is mitigating FX risk. It's mandatory. You have to price deals in hard currencies, typically the US dollar, even if the assets generate local currency returns. Then you use hedging, or you can structure multi-tranche payments that are linked to currency milestones to manage that volatility. You just can't ignore it. Third is regulatory compliance, which is just non-negotiable. Frontier markets have complex capital controls, repatriation challenges, foreign ownership limits.
Minefield.
It can be. And this means you need early and deep engagement with local legal and financial advisors to ensure the structures are actually compliant and executable. You have to avoid a catastrophic blockage down the line.
Okay, and the fourth one you mentioned is aligning with DFIs. What does DFI alignment mean for a deal structure?
So DFIs, development finance institutions, they are key anchor investors in these markets. Their involvement means a transaction has to align with their ESG and developmental mandates. And you do this through blended finance or co-investment structures where private capital works right alongside the DFI, leveraging their local knowledge and, frankly, their regulatory weight.
It's a powerful illustration of that idea you mentioned earlier.
Exactly. It's what the quote says. Frontier markets show innovation often arises from constraint. When traditional exit paths narrow, effective structures open new avenues for performance and partnership. Necessity is really driving this ingenuity.
That really captures the spirit. Okay, let's shift focus a bit to two new liquidity solutions that are gaining massive traction, especially as exit timelines just keep getting longer.
They really are.
We're seeing this dramatic rise in private credit secondaries. I mean, this segment has nearly doubled, from $6 billion in 2023 to $11 billion in 2024, and is projected to go past $18 billion in 2025. Why are investors pivoting so hard to credit secondaries right now?
It reflects a general search for yield, but it's combined with a desire for more predictable debt-like cash flows. I mean, when you can't guarantee an IPO exit in 5 years, having assets with stable contractual cash flows becomes much, much more attractive.
And alongside that trend, there's the increasingly relevant concept of NAV loans. These are loans where a fund can borrow against its portfolio's net asset value to support things like follow-on investments or just to meet investor liquidity needs.
This is a brilliant tactical tool for emerging markets. If you've got a fundamentally strong asset, but you know you might be waiting years for a conventional exit because of market conditions, a NAV loan lets you unlock cash flow today without having to sell at a discount.
So it sustains growth during that waiting period?
Precisely.
So the success of these NAV loans really hinges on managing the risk of the underlying assets. How do buyers and lenders control that exposure?
It all depends on careful covenant design, the rules of the loan, and very strict loan-to-value, or LTV, monitoring. Lenders have to constantly track that LTV ratio to make sure the asset value stays far above the borrowed amount. It creates a strong buffer against volatility. And of course, regulatory compliance has to be watertight. But overall, that stabilization we talked about, LP-led deals holding steady around 89% of NAV, it means the pricing environment is actually highly attractive for institutional investors right now. They're getting access to mature, seasoned assets at a discount, which can dramatically help with portfolio diversification.
To bring this all home and make it tangible for you, the listener, let's look at how these complex principles are actually being applied on the ground. We need to see the ingenuity in action.
We do. These case studies really show how these secondary-style strategies are being specifically adapted for frontier markets where, the standard PE rules just don't apply.
So give us an example.
Okay, take the first one, which illustrates structured credit. A $150 million refinancing for the Mongolian Mortgage Corporation. This deal was focused on refinancing a seasoned pool of mortgage assets, so investors got exposure to portfolios of performing loan contracts loans that were already being reliably repaid.
So it's not equity, it's debt streams.
Exactly. It mirrors the benefits of an asset-backed secondary deal. You're leveraging existing predictable cash flows instead of relying on an equity sale down the road. It's a totally different risk profile.
Okay, that makes sense. What about an infrastructure?
A great example there is the continuation-style renewable structure with MPC Energy Solutions. Here, investors acquired a seasoned portfolio of operating renewable energy assets. The structure let the GP extend the asset life and recycle their capital into new projects. But crucially, by buying operating assets, it dramatically reduced the greenfield risk.
The risk of building something from scratch.
Exactly. The high uncertainty and cost associated with building new power plants from the ground up in emerging regions, you bypass a lot of that. And finally, look at recap strategies for growth with Pearl Dairy Farms in East Africa. This was a $35 million recapitalization and expansion package for a leading agribusiness. It recycled capital into an already proven operating asset. Its success really hinged on three things: predictable cash flows, the farm was already selling product clear risk sharing among investors, and a thoughtful multi-tranche structure.
Tell us a bit more about that multi-tranche structuring. How did that specifically help in a deal like that?
So multi-tranche structuring means the capital was split into layers. Maybe one tranche was senior debt, another was mezzanine debt, and a third was growth equity. This separation allows different investor risk appetites to be met all at once, and it ensures resilience. If one part of the business struggles, the different layers of capital provide buffers and clear waterfalls for repayment. It makes the whole package far more durable.
Those examples make it so clear. Success in these markets isn't about finding a one-size-fits-all solution. It's about layered financing, strong governance, and above all, really creative liquidity design.
Those are the key ingredients.
They seem to be the key to creating durable investments and real long-term value in the world's most dynamic economies.
Absolutely. And the final synthesis here is that the future of secondaries in these markets, it rests on a continued push for better governance and more standardized processes. While the challenges are real, the FX risk, the regulatory hurdles, the opportunity remains exceptionally strong for buyers to acquire interests below NAV, which helps their own portfolios and provides essential liquidity to the earlier investors.
And that really is the essential takeaway for you, our listener. Secondaries are no longer just a tactical option for portfolio maintenance. They are a foundational, strategic approach to optimizing private market outcomes in these incredibly dynamic economies. How are you going to use these new structural insights to unlock value in your own investment or knowledge portfolio? This has been Delphos Insights. Learn more at delphos.co.